All right, so we're going deep today, deep on index investing. And I know there are a lot of folks out there who
Absolutely.
may be familiar with it, but
Right.
not quite sure like how it really works or why they should care.
Yeah.
So that's what we're diving into.
Yeah, we're going beyond just, the surface level,
Right, yeah.
Like you've heard about it, you kind of get the concept.
Right, yeah.
But let's actually break it down and why it matters.
Yeah, no, and especially I think for, folks who are thinking about long-term investments.
Right.
Right? They're not looking to
Absolutely.
They're not looking to make a quick buck.
Absolutely not.
They just want to kind of, put their money somewhere
Yeah.
safe and have it grow over time.
Right, exactly. Steady growth.
Yeah.
Just let it ride.
Yeah.
And that's a big part of what index investing is about.
So, when we talk about index investing, what are we?
So really it's all about trying to match as closely as possible the performance of a particular market index.
Okay.
And a market index, you can think of it as like a basket of securities. It could be stocks, it could be bonds that are designed to represent a particular segment of the market.
Okay, and so we're talking about the S&P 500.
Exactly, yeah. The S&P 500 is a very popular index, the FTSE 100.
Okay.
The NASDAQ composite, these are all just
Got it.
collections of companies that give you a snapshot of how a particular market is performing.
Yeah.
So the idea is, instead of trying to pick and choose individual stocks, you're basically saying, I want to buy a little piece of all of these companies.
Oh, so it's like diversifying your portfolio.
Exactly. Diversification is a huge part of index investing.
Got it. Okay.
So instead of putting all your eggs in one basket. Right.
Right. You're spreading your money across a whole bunch of different companies.
So it's like I don't know, instead of just having just chicken for dinner every night.
Exactly. Yeah. You want a balanced diet.
You want a balanced portfolio, right?
You don't want to just eat, one type of food.
Okay.
You want to get a little bit of everything.
That makes sense.
To make sure you're, getting all the nutrients you need.
Okay. So, all right. So we're spreading the risk, right? That's what the diversification is about.
Right. And that helps you ride out the inevitable ups and downs of the market.
Right.
Right. Because if one company, has a bad quarter, your entire portfolio doesn't tank.
Right, because you have a whole bunch of other stocks that are hopefully doing well.
Exactly. It's like taking the average temperature of a city.
Oh, okay.
One hot spot doesn't mean the whole city is burning up.
Right.
Right. So you're kind of smoothing out
the overall.
I like that analogy.
Yeah.
That makes sense.
The overall picture, you're not getting these wild swings.
Okay, so all right, so we got diversification. What's another key advantage here?
Another key advantage is cost. Index funds tend to have much lower fees than actively managed funds.
Oh, okay. Why is that?
So actively managed funds, they have a team of analysts who are constantly researching companies, trying to pick winners, trying to beat the market.
Yeah, so they're doing a lot of work.
Yeah, they're doing a lot of work, and that work costs money.
Right.
Right? They have to pay their analysts, they have to pay for their research, and all of that gets passed on to the investors in the form of higher fees.
Okay.
But index funds, they're not trying to beat the market, they're just trying to match it.
Right.
So they don't need that big team of analysts.
So they don't have all those expenses. Right. They're just basically buying and holding the stocks that are in the index.
Which is a much more passive approach and therefore much cheaper.
So lower fees. That's
lower fees.
Always good.
Always good.
All right. What else? What else we got?
Another big one is transparency.
Okay. Explain that one.
So with an index fund, you know exactly what you're investing in. The index is publicly available, so you can go online, you can look up the S&P 500, for example, and you can see all 500 companies that are in that index.
So you're not in the dark.
You're not in the dark. You know exactly
about where your money's going.
Where your money's going.
Okay.
Whereas with an actively managed fund, the manager might have some discretion.
Right. Okay.
Over what stocks they buy and sell.
Okay. Yeah.
So there's a little bit more of a black box.
It's like the mystery meat of the investment world.
Exactly. You don't know what's in there.
Okay. I like that. Yeah. No mystery meat for me.
Right. With index funds, it's like, you're looking at the ingredient list.
Yeah.
You know exactly what's going into your food.
Okay. So that's good. So we got diversification, lower cost, transparency.
Yeah.
Anything else I should be excited about?
Well, consistent returns, too.
Right,
You
yeah.
know, we talk about index funds being designed to match the market.
Yeah.
And over the long term, the market tends to go up.
Okay.
So by investing in an index fund, you're essentially betting on the overall growth of the market.
Okay, and so, like, how consistent are we talking? Like,
Well, I mean, it's not going to be like a straight lineup. You know,
sure.
there's going to be ups and downs. There's going to be years where the market's up. There's going to be years where the market's down.
Right.
But over the long term, the trend has been upwards.
So it's kind of like you said, that tortoise and the hare race, right?
Exactly. Yeah, the slow and steady
And steady.
wins the race.
Wins the race, okay.
You're not trying to get rich quick. You're just trying to build wealth over time.
Got it. Okay, so, but like, are we going to miss out on, those potentially huge GE gains by not trying to beat the market?
That's a question a lot of people have, and it's a valid concern.
Yeah.
But the thing is, trying to beat the market is really, really hard.
Okay.
And a lot of actively managed funds, they actually fail to do it.
Really?
Yeah. And even if they do manage to beat the market in 1 year,
Yeah.
there's no guarantee they'll be able to do it again the next year.
So it's really
Really.
kind of luck of the draw with a lot of those.
A lot of it is luck, yeah, and you're still paying those higher fees.
Right, even if they don't.
Even if they don't perform well, exactly.
Oh, that makes sense.
So index investing is more about consistency. It's about, not taking on excessive risk
Right.
and just letting the market do its thing over the long term.
Okay, so it's kind of like, I plant a tree, I let it grow, right?
Exactly, yeah. You don't have to constantly be out there,
Right.
watering it, fertilizing it, pruning it.
You just kind of let it
You just kind of let it do its thing.
do its thing.
And over time, it'll grow into a big, strong tree.
I like that analogy, Ari. So, but there are, like when we say index funds, there are a lot of
There are a ton of different index funds out there.
different kinds, right?
Yeah. You've got index funds that track the S&P 500. You've got index funds that track the, international markets.
Okay.
You've got index funds that track bonds. You've got index funds that track commodities.
So it's not just limited to,
No, it's not just stocks.
like the stock market.
No. There's a whole universe
Okay.
of index funds out there.
So someone could really create like a whole, diversified portfolio just using index funds.
Absolutely, yeah. You can create a portfolio that aligns perfectly with your goals, your risk tolerance, your time horizon. You mentioned earlier about wanting long-term, low-hassle investments.
Right. Yeah.
Index funds are perfect for that.
Okay, so we're checking all the boxes so far.
Yeah.
Anything else? Anything else I'm missing?
Well, we talked about costs being low, but there's also a potential tax advantage to index funds.
Ooh, tell me more about this. We all love a good tax break.
Right. Well, because index funds aren't constantly trading stocks, they generate fewer capital gains.
Yeah.
And capital gains are what you get taxed on when you sell an investment for a profit.
Right.
So the less you trade, the fewer capital gains you'll have, and the less you'll have to pay in taxes.
Okay, so that's good news. All right, so you also mentioned, at the top of the show, like the historical performance of these indexes.
Right. Yeah. I mean, if you look at the S&P 500, for example,
Yeah.
over the long term, it has delivered really impressive average annual returns.
Okay.
It's not every year. Like I said, there's going to be ups and downs.
Right.
But over the long term, the trend has been up.
So it's about trusting that trend is going to continue.
Exactly. And by investing in an S&P 500 index fund, you're essentially tapping into that historical growth potential.
Okay, so it's kind of like riding the wave.
Yeah, you're riding the wave of the overall market.
Of the overall market. Okay, all right. So, it sounds like we've got a lot of good things going for index investing here.
Yeah.
Diversification, low cost, transparency, tax efficiency, historical performance. Like, what's the catch?
Well, the trade-off, and there's always a trade-off.
Right.
The trade-off is that you're not going to outperform the market. You're aiming to match it minus the fees.
Got it.
So if you're someone who's really, into stock picking, you think you can beat the market.
Right. Yeah. If you're a day trader, this is not for you.
This is not for you. Yeah. This is more for the passive investor who
Okay.
just wants to set it and forget it.
All right. So for someone like me, and maybe you listening, right, who really values like simplicity and long-term growth, like index investing, it sounds like a pretty solid tool to have in the toolbox.
It's a very valuable tool. Yeah. It's not the only tool.
Right.
Right. But it's definitely one that you should consider.
Okay, so what should folks keep in mind as they're, thinking about this, diving deeper themselves into index investing?
Yeah, I think the most important thing is to really understand your own individual goals.
Okay.
What are you trying to achieve with your investments?
Mhm.
What's your risk tolerance?
Yeah.
How long do you plan on investing?
Right.
Once you have a good understanding of those things, then you can start to look at specific index funds
Okay.
and see which ones might be a good fit for you.
Got it. So it's not one size fits all.
It's not one size fits all.
Okay, but it's a tool that everyone should at least be aware of.
Absolutely. I mean, knowledge is power,
There
right?
you go.
The more you know about different investment options,
Yeah.
the better equipped you'll be to make the best decisions for yourself.
I like that. All right. Well, I think that's a wrap for our deep dive on index investing today.
Sounds good.
I hope you learned something. I know I did.
Me.
And as always, keep learning, keep exploring, and make those smart investments for your future.
Absolutely.
Thanks for tuning in.
Cheers.